We now come to the final section of this reading, which is exchange rates, international trade balance, and capital flows. The impact of exchange rates and other factors on the trade balance must be mirrored by their impact on capital flows. This is a very important and testable point, and possibly a source of confusion. So let me first just clarify some confusion between terminology used here and terminology used in the previous reading. What this reading is doing is taking capital flows and essentially covering both the capital account and the financial account that we discussed in the previous reading. So on your exam, when you see capital flows or capital account, you need to look at the answer options and determine from the context what exactly is meant by capital. In this context, the capital is essentially capital / financial flows, and it covers both the capital account and the financial account from the previous reading. Roughly speaking, the trade balance is covered by the current account. Now, what this point is saying is that if we take a country perspective, which is the perspective that we take in this discussion on international trade, so this is a given country. If the country has a trade deficit, which means that exports are low and imports are high, the X minus M is negative, then this particular country must borrow from the rest of the world, either borrow from the rest of the world or the rest of the world must be buying assets in the country. In other words, money from the rest of the world or foreign exchange has to flow into the country in order to fund this trade deficit. These two numbers, the trade deficit and the capital inflow in this context, must be equal and opposite. The sort of questions that you will see in the curriculum will use the following terms. A trade deficit must be balanced by an offsetting capital surplus, or a trade surplus will be balanced by a capital deficit. So make sure that you understand this terminology, and when you practice a few questions, then you will be on top of this material. Another important testable point is that a trade surplus reflects an excess of domestic savings over investment spending. Here is the relationship that you need to remember. X minus M, or the trade surplus, is equal to private savings minus investment. So this is the savings that individuals or private entities do above the investments which are made in a given country. This is the business investments, plus T minus G. T is the revenue that the government gets, G is government spending. So this is actually government savings. If this is government savings, this is private savings, then effectively you can see that X minus M is based on the difference between overall savings and the investment number. If overall savings, both private and government, are very high relative to investments, that would mean that we will have a high trade surplus. If the savings are low relative to investments, then this number will be negative, which means that we have a trade deficit. In case you have trouble remembering this formula, here is what I suggest you do. Remember from an earlier reading in macroeconomics, we said that there has to be an equality between income and expenditure. Income must be equal to the total consumption plus savings plus taxes. That is the three places where income goes: consumption, savings, and taxes. This is equal to expenditure, and I'm sure you remember this, that expenditure is equal to the consumption plus investment plus government spending plus expenditure by the rest of the world, which is X minus M. From here you can easily see that C and C cancels out, then x minus m is equal to s minus t plus t minus g. So note that this relationship can be easily derived as long as you remember the basic point that income must equal expenditure. There are several questions in the curriculum that test this concept, so make sure you are on top of this. And I think this is particularly testable because this concept shows up in several places, and make sure you are on top of this. Next point, capital flows, both potential and actual, are the primary determinant of exchange rate movements in the short to intermediate term. And this is basic supply and demand. If the demand for a particular currency is high, possibly because the rest of the world wants the goods and services produced by this country, then the currency will strengthen. If the demand for the currency is weak, then the currency will weaken. The impact of the exchange rate on the trade balance can be examined using the elasticities approach and the absorption approach. The point here is that if the currency either appreciates or depreciates, what is the impact on the trade balance of a country? And that impact can be evaluated using these two approaches. These might seem a little bit complicated, but they connect very well with material that you have seen earlier, which is why I think this is important. In section 5.1, we will talk about the elasticities approach, and you will note that this approach is based on microeconomic concepts that you studied early in economics. Here you need to learn what is called the Marshall-Lerner condition. This condition describes the combinations of export and import demand elasticities such that depreciation of the domestic currency will move the trade balance towards a surplus. We can also say that the Marshall-Lerner condition describes combinations of export and import demand elasticities such that an appreciation of the domestic currency will move the trade balance towards a deficit. And this is the condition which I will explain. The W over here stands for the relative weight of exports. Wx is weight of exports. Wm is the weight of imports. This is the elasticity of exports and this is the elasticity of imports. If this condition holds, this condition being that expression being greater than 0, then a currency depreciation will reduce the trade deficit. So if the trade deficit, for example, is 200, which means that imports are more than exports, if this condition holds and the currency is depreciated or the currency depreciates, then the trade deficit will become less. Let us look at an example and then we will go back to this formula. This example is based on what is given in the curriculum. Let's say that our domestic country is Italy, which operates in euros, and Italy trades with the United States, which operates in dollars. Initially, Italy's exports are 400 million and Italy's imports are 600 million. Clearly, we have a trade deficit of 200 million and initially the total trade is 1 billion. We are also told that the demand elasticity for exports is 0.75 and the demand elasticity for imports is 0.65. And what do these numbers mean? A demand elasticity of 0.75 means that if prices go up by 1%, then the quantity demanded will come down by 0.75%. If we say that the domestic currency, here the euro, depreciates by 10%, so the euro is down by 10%, what will happen to exports? Clearly, for the trading partner, in this example, the United States, Italian products will become cheaper because the currency euro is becoming less valuable compared to the dollar. So from a US perspective, Italian goods are now cheaper. In fact, we can say that from a US perspective, the price is actually down. If the price is down, then the quantity will be up. But by how much? If the price is down by 10%, then the quantity demanded will be up by 7.5%. If the original quantity of exports was 400 and now the price from a US perspective is down by 10%, the quantity will go up by 7.5% of 400,000, and that is 30 million. So exports up by 30 million. And this is 30 million euro. Remember, our calculations are being done from an Italian perspective, so that would be a euro perspective. Italy is still getting money in euro. America is buying more. From an American perspective, things are cheaper, so they are buying more. But from the export part of the trade, Italy is getting 30 million more, and that is reflected over here. Some students get confused about the fact that the price is not changing, and again I'll emphasize that is because as far as Italy is concerned, it is still getting euro. So if euro has devalued for the rest of the world, as far as Italy is concerned, 30 million euro is still 30 million euro. What about imports? Italy is importing 600 million worth of goods from the United States. When the currency weakens, what will happen to imports? And here there will be two impacts. Now, with the currency weakening, the price of the imports is obviously up. The price is up by 10%. In euro terms, the price is up by 10%, and the quantity will be down. Now, by how much does the quantity reduce? Given that the elasticity of imports is 0.65, this means that if the price goes up by 1%, the quantity will come down by 0.65%. If the price goes up by 10%, the quantity will come down by 6.5%. So here we have two impacts in opposite directions. In euro terms, the imports are more expensive by 10%, but the quantity is 6.5% less. The net impact is 10 minus 6.5, which is plus 3.5%. This means that in euro terms, the value of the imports is up by 3.5%. If the value of the imports initially was 600 billion, now the value of imports will be 3.5% more, which means 21 million. 21 million is 3.5% of 600 million. So overall, what is happening? The exports increased by 30 million. The import, again in euro terms, increased by 21 million. Note that here both numbers went up. Exports went up, imports went up, but exports went up by more than the imports, and the trade balance actually reduces by 9 million because exports went up 9 million more than imports. Therefore, the trade balance now is 9 million better. Initially, our trade balance was a deficit of 200 million. Now that deficit has been reduced by 9 million. Initially, the total trade was a billion. Now that total trade has increased by 51 million because both the imports and the exports have increased. Let us now come back to this Marshall-Lerner condition, and we'll see that this condition does indeed hold true. When you plug in the numbers, the weight of exports, that is equal to 0.4. Notice exports are 40% of the total initial trade, multiplied by the elasticity for exports, which is 0.75, plus the weight of imports, which is 0.6, into elasticity of imports, which is 0.65 minus 1, and this will give us 0.09, which is greater than 0. So the Marshall-Lerner condition does hold, and since this condition does hold, we have a reduction in the trade deficit because the currency went down in value. Let us also connect this 0.09 now with this number over here. What does 0.09 mean? This means that a 1% decrease in value of the currency will improve the trade balance by 0.09%, which means that a 10% reduction in value of the currency will improve the trade balance by 0.9%. If you take 0.9% of our original trade balance, we will get 9 million. So that is the connection between this and the calculation that we have done. And I hope you recognize what is going on over here. Behind all this somewhat complicated looking calculation, the basic idea is straightforward. The impact on the trade surplus or deficit depends on the elasticities of the imports and exports. Clearly, if the elasticities are high, and these are the price elasticities, if the elasticity of imports and exports are high, then a change in value of the currency is going to have a large impact on the trade balance. On the other hand, if the imports and exports are not very price elastic, then changes in the price of the currency, which is the exchange rate, will not have much of an impact on the trade balance. On this slide, we will make a few more points related to the elasticities approach. As discussed on the previous slide, when a currency depreciates, the trade balance will reduce if the Marshall-Lerner condition holds. When we say that the Marshall-Lerner condition holds, we mean that this expression is greater than 0. Now, I just want you to understand the 4 different scenarios that can take place. And what we will do is look at the impact on X minus M. This is the trade surplus, or you can look at this as the negative deficit, but it's easier to think of X minus M. What is the impact on X minus M in 4 different scenarios? Now, what are those 4 scenarios? They are depicted in this 2x2 matrix over here. The vertical axis represents currency. This means currency going up, and the bottom part is currency going down. On the horizontal axis, we represent whether this expression is positive or negative. These 2 boxes over here represent situations where this expression is positive. So we can say that in these 2 boxes, the Marshall-Lerner condition holds, and in these 2 boxes on the right, the Marshall-Lerner condition does not hold. The scenario that we just saw was this box at the bottom left, because the currency devalued and the Marshall-Lerner condition did hold. In other words, this expression was positive. we were over here and x minus m went up, which means that if we have a deficit, so if this is x minus m, a deficit means we are somewhere over here. Let's say that this is 0, neither a deficit nor a surplus. When we are in this box, then the deficit becomes less. In other words, x minus m is increasing. What if the currency appreciates and the Marshall-Lerner condition does hold? Then x minus m will come down. On the right hand side, where the Marshall-Lerner condition does not hold, in other words this expression is negative, then what will happen? A devaluation of the currency will actually cause x minus m to come down, and an appreciation of the currency will cause x minus m to go up. I have gone over this because when you do example 8, this information will come in handy. And if you can just understand this one, currency down, Marshall-Lerner holds, then x minus m goes up. From this you can come up with the 3 other boxes very easily. The second point I want to make here is that the impact of a change in currency value depends on elasticities, and that is fairly obvious when you look at this expression. If the elasticity numbers are high, then this number, the overall number, will be more positive. And if you recall, on our previous slide, we had a certain number which was 0.09, which represented a change in x minus m when there is a 1% change in price being the exchange rate or the price of the currency. If this number is more positive, then the impact will be more. And I'll repeat, higher elasticities will make this number higher. So remember the fact that if the elasticity is more, the impact is more, and that is also fairly intuitive. The next question is, what do these elasticities depend on? And the answer is that elasticity depends on whether they are close substitutes or not, whether the goods being imported or exported are luxury goods, whether the goods represent a significant percentage of income or not. And I hope all this sounds familiar because this is exactly what we studied early on in microeconomics. And I think it is useful to see this particular approach because it builds on microeconomic fundamentals and it helps you revise what you need to know. The final point is that we might have a J-curve effect when there is a change in value of the currency. What that means is the following. We have a certain trade balance and let's say that the currency devalues. We might think that the trade balance will improve, x minus m will go up if the Marshall-Lerner condition holds, but in the short run it is likely that the trade balance will actually decrease. And there are two ways of thinking about why this will happen. One reason is that if the currency becomes less valuable, the impact on imports is immediate, but the impact on exports will take some time to kick in. That's why initially x minus m actually goes down and eventually it will go up. The other way of looking at this is that the elasticities represented in this relationship are really longer term elasticities. As we saw earlier in microeconomics, elasticities might be different depending on the time frame that we are considering. If we simply take a very short time frame, then elasticities tend to be relatively inelastic and elasticity increases with time. So it is quite likely that the elasticities that we are considering here are over a longer time frame. We now come to the second approach, which is called the absorption approach. This approach is based on macroeconomic principles And I think the best way of covering this approach is by going over the summary in the curriculum. I will read the summary and explain this to you. In order to move the trade balance towards a surplus, a change in the exchange rate must decrease domestic expenditure. That expenditure is also called absorption. That's where the name comes from. So, must decrease domestic expenditure relative to income. Another way of expressing this is that the change in exchange rate must increase domestic saving relative to domestic investment. This relationship, which I hope you have memorized by now, illustrates the point very well. If there is an increase in savings relative to investment, then X minus M goes up. X minus M goes up means that we move towards a surplus. If we are in a deficit, then the deficit becomes less. If we have a surplus, then the surplus increases. Also notice that G minus T represents government savings. Overall, if savings are up relative to investment, then X minus M goes up. If savings are down relative to investment, then X minus M will come down. If there is excess capacity in the economy, then currency depreciation can increase the output or the income by switching demand toward domestically produced goods and services. Because some of the additional income will be saved, income rises relative to expenditure and the trade balance improves. I hope this is self-evident. Clearly, if the currency decreases in value, then the imports become more expensive, which means that the demand for domestically produced goods goes up, which means that income will go up, and because some of that additional income will be saved, that means that our savings numbers will go up relative to investment and X minus M will go up. This is the situation where there is excess capacity in the economy. What if we do not have excess capacity? If the economy is already at full employment, then currency depreciation must reduce domestic expenditure in order to improve the trade balance. The main mechanism is a wealth effect. A weaker currency reduces the purchasing power of domestic currency denominated assets, and households respond by reducing expenditure and increasing saving. So in other words, people feel less rich. When people feel less rich, then the assumption here is that people save more. And again, back to this relationship. If people save more, then X minus M will go up. Let us summarize the main points from this reading now. You need to understand nominal and real exchange rates. The key relationship here is the one that I spent a lot of time on, which is that the real exchange rate expressed as follows: price currency over base currency is equal to the spot exchange rate, again price over base, multiplied by the price level in the base currency over the price level in the price currency. The price level could be indicated by the CPI. We then talked about direct and indirect exchange rates. If you are a German investor, then for you a direct exchange rate will be one where the US currency is the base currency. Appreciation means that a currency is becoming stronger. Depreciation means that a currency is becoming weaker. If we have the following exchange rate quote, 1.4000 USD for 1 euro, and this number goes up to 1.5. Here euro is the base currency. If the exchange rate goes up, this means that the euro or the base currency is becoming stronger and the price currency is becoming weaker. Spot rates are the rates that are in the market today. More specifically, spot rates are generally T+2, which means that the agreement is made today and the transaction is made 2 days later. But for the sake of this reading, we effectively say that spot rates are the rates in effect now. A forward rate is a rate that we agree upon today and the transaction happens at some point in the future. Cross rates are rates that we derive based on two other rates. And going back to a very simple example, if we have the PKR to USD rate, let's say that is 100, and we have INR to USD, let's say that is 60, then the rate that we derive using these two rates is called the cross rate. Currency exchange rate regimes. Here we talked about a spectrum of different regimes ranging from fixed to floating, and I would say that you memorize all the points that were in the slides presented. They cover the most important points. And finally, impact of exchange rates on trade and capital flows. Here we talked about an elasticities based approach and the absorption approach. The elasticities based approach says that the impact on the trade balance depends on the elasticity of exports and the elasticity of imports. The greater the elasticity, the more the impact will be of a change in exchange rate. And the absorption approach is based on macroeconomic principles, which says that as long as savings go up relative to investment, then that will have a positive impact on the trade balance. As always, I want you to read the summary, review the learning objectives. In these lectures, I have actually used the examples from the curriculum. I think those examples are very good. Make sure you also do the examples on your own. There are a few MCQs that I skipped. Make sure that you do those very well also. Do all the practice problems, and if you have time, also do practice questions from other sources.